Portfolio Construction and Risk Management. Chapter 9, Rebalancing Strategies. Section 1. Why rebalance? Every portfolio begins with a target allocation, and that target is not arbitrary. It reflects the investor's goals, time horizon, need for growth, and tolerance for losses along the way. But even if the investor makes no trades at all, the mix will not stay frozen, because stocks, bonds, and cash do not grow at the same pace. One asset class may surge while another lags, and that alone changes the portfolio's weights. So, over time, the portfolio quietly drifts away from the original plan. Rebalancing exists because a portfolio is not self-maintaining. That drift matters because a change in weights is really a change in exposure. If a 60% stock and 40% bond portfolio becomes 70/30 after a strong stock market, the investor is no longer holding the same risk profile they chose at the start. The portfolio may be more sensitive to equity market declines, even if recent performance has looked good. This is why drift is not just a performance story. It is a risk story. The question is not simply whether stocks went up, but whether stocks now occupy too much of the portfolio. Rebalancing is the tool that responds to that shift in exposure. In simple terms, rebalancing means moving the portfolio back toward its intended mix. That usually involves trimming positions that have become too large and adding to positions that have fallen below target. If stocks have run ahead and bonds now represent too little of the portfolio, the investor sells some stocks and buys bonds. The point is not to reverse every market move, but to restore the structure of the plan. This keeps the portfolio from being driven entirely by whichever asset class happened to do best most recently. Rebalancing turns the target allocation from a one-time decision into an ongoing policy. The main purpose of rebalancing is risk control, not return maximization. It helps prevent market movements from slowly transforming a moderate portfolio into an aggressive one, or a growth-oriented portfolio into one that has become too defensive. In that sense, rebalancing protects the investor's investment policy from being rewritten by the market. It also reduces the need to make judgment calls based on headlines, forecasts, or emotion. The discipline is simple: stay aligned with the chosen level of risk. A well-run rebalancing process is really a way of preserving consistency through changing markets. Rebalancing can also have a useful side effect for long-term returns, although that is not its primary job. By trimming recent winners and adding to lagging assets, it sometimes resembles the discipline of selling high and buying low. It can reduce concentration in whatever has been hottest lately, which may help prevent a portfolio from becoming overly dependent on a single strong trend. But this benefit is not guaranteed, and there will be periods when rebalancing appears to hold back returns. In a strong bull market, for example, letting winners run may look better for a while. That is why any return benefit should be viewed as secondary to the core goal of risk control. This is also why rebalancing should not be confused with market timing. A market timer is trying to predict what will outperform next and trade based on that forecast. A rebalancer is following a rule that says the portfolio has moved too far from its intended mix. No forecast is required and no claim is being made about what asset class will win over the next month or year. That difference matters because rule-based decisions tend to reduce emotional reactions. Rebalancing helps investors avoid the common temptation to chase the asset that has already done well. A practical rebalancing process usually follows a few clear steps. First, set target allocations for the major asset classes in the portfolio. Then monitor the current weights so you can see when drift has developed. After that, choose the rule that will trigger action, such as a calendar review or a threshold band around the target. If the rule says a rebalance is needed, trade the portfolio back toward target rather than improvising. Before executing, it is wise to check transaction costs, taxes, and account type, because good implementation can make a meaningful difference. A threshold rule helps separate harmless drift from meaningful drift. Suppose a portfolio starts at $100,000 with 60% in stocks and 40% in bonds, and the investor allows stocks to move within a band of plus or minus 5 percentage points. After the first year, stocks rise to about 8%, which is still inside the 55 to 65% range, so no action is taken. After another gain, stocks reach about 9%, which is outside the band and therefore triggers a rebalance. At that point, the investor would sell roughly $8,520 of stocks and move that amount into bonds. The rule creates a clear line between normal fluctuation and drift large enough to justify trading. Rebalancing is useful, but it is not free. Every trade can bring commissions, spreads, market impact, or tax consequences, especially in taxable accounts. If an investor rebalances too often, the portfolio may generate unnecessary friction without much added benefit. If they wait too long, drift can become large enough that the portfolio no longer resembles the intended strategy. This is why implementation matters as much as the concept itself. The goal is not maximum trading activity, it is efficient control of the portfolio's risk profile. Section 2. Time-based rebalancing. One common way to implement rebalancing is to use the calendar as the trigger. Under time-based rebalancing, the investor reviews the portfolio on scheduled dates, such as every quarter, every 6 months, or once a year. If the holdings have drifted away from target, they are reset back toward the intended weights. The important feature is that action is driven by the date, not by whether drift crossed a specific threshold yesterday. This makes the process easy to schedule and easy to remember. It also keeps investors from reacting to every short-term market move. Investors often choose this approach because it is simple and manageable. A fixed review schedule fits naturally with regular portfolio checkups, annual planning, or recurring financial routines. That clarity can support better behavior because the investor knows exactly when decisions will be made. It also reduces the urge to watch markets constantly and respond to every bout of volatility. For many long-term investors, that simplicity is a real advantage. A plan that is easy to follow is more likely to be followed consistently. The trade-off is that a calendar rule does nothing between review dates. If the market becomes volatile right after a rebalance, the portfolio may drift substantially before the next scheduled review arrives. A stock-heavy portfolio could become even more equity-heavy during a rally, raising risk above the level the investor intended to hold. Time-based rebalancing accepts that temporary drift in exchange for procedural simplicity. That does not make it wrong, but it does mean the investor must be comfortable with some movement away from target. In calm markets, that may not matter much. In turbulent markets, it can matter more. Choosing the interval is really a balancing act. Annual rebalancing is very common because it often gives a reasonable mix of simplicity, drift control, and lower trading frequency. Semi-annual or quarterly reviews provide tighter control, but they also tend to increase trading activity and, in taxable accounts, may increase tax friction. Monthly rebalancing is usually less attractive unless there is a very specific reason for it, because the additional precision often comes at too high a cost. There is no universal best schedule. The right interval depends on the investor's tolerance for drift, account type, and desire for simplicity. Once the review schedule is set, the mechanics are straightforward. Start with the target weights for each asset class, such as 60% stocks, 30% bonds, and 10% cash. On the scheduled date, calculate the portfolio's current total value, and then the target dollar amount for each asset class. Compare those targets with the actual holdings to see what is overweight and what is underweight. Then sell from the overweight positions and buy the underweight ones until the portfolio is brought back toward target. After recording the trades, the investor simply waits until the next scheduled review. Two simple formulas make the calculation process easy to repeat. The first is target amount, which equals total portfolio value multiplied by the target allocation. In a $100,000 portfolio with a 60% stock target, the target stock amount is $60,000. The second is trade needed, which equals target amount minus current amount. If the result is positive, that asset needs to be bought. If the result is negative, that asset needs to be sold. These formulas turn rebalancing into a mechanical exercise rather than a judgment call. Here is a concrete example. On January 1, a portfolio worth $120,000 is reviewed under a semi-annual schedule with a target of 70% stocks and 30% bonds. The current holdings are $96,000 in stocks and $24,000 in bonds, which means the portfolio has drifted to 80/20. The target amounts should be $84,000 in stocks and $36,000 in bonds. To get back on target, the investor sells $12,000 of stocks and uses the proceeds to buy $12,000 of bonds. In a taxable account, This is also the moment to ask whether selling appreciated stock will trigger capital gains taxes. 6 months later, the same portfolio is reviewed again. Its value is now $125,000, with $81,250 in stocks and $43,750 in bonds. Because the total portfolio value has changed, the target amounts also change to $87,500 in stocks and $37,500 in bonds. This time, stocks are underweight and bonds are overweight, so the investor buys $6,250 of stocks and sells the same amount of bonds. The example shows an important point. Time-based rebalancing is predictable, but drift can occur in either direction between reviews. Each review date resets the portfolio using the current value, not the old one. A time-based plan can often be made more efficient by using cash flows before placing extra trades. If new money is coming into the portfolio, those contributions can be directed toward underweight asset classes. If the investor is taking money out, withdrawals can come first from overweight positions. Dividends and interest payments can also be redirected to areas that need support. This approach may reduce the number of taxable sales and lower transaction costs. In practice, cash flows are one of the simplest ways to improve a calendar-based rebalancing process. Consider a worked exercise with a $50,000 portfolio targeted at 50% US stocks, 30% international stocks, and 20% bonds. The target dollar amounts are $25,000, $15,000, and $10,000 respectively. At the March 31st review, the actual holdings are $30,000 in US stocks, $12,000 in international stocks, and $8,000 in bonds. That means US stocks are overweight by $5,000, international stocks are underweight by $3,000, and bonds are underweight by $2,000. The rebalance is to sell $5,000 of US stocks, buy $3,000 of international stocks, and buy $2,000 of bonds. The exercise shows how a scheduled review translates directly into a small set of clear transactions. The key takeaway is that time-based rebalancing is a risk control tool, not a return promise. It can be effective because it creates a steady, repeatable process, but it works best when the interval is chosen thoughtfully. Rebalancing too frequently can create unnecessary taxes and trading costs, while waiting too long can allow meaningful drift to build. Using contributions, withdrawals, and distributions intelligently can improve the process further. The practical question is not whether time-based rebalancing is perfect, but whether its simplicity fits the investor's goals and tolerance for drift. From here, it helps to compare that calendar approach with a rule based on drift itself. Section 3. Threshold rebalancing. Threshold rebalancing takes a different approach by letting portfolio drift rather than the calendar determine when action is needed. The investor sets tolerance bands around each target allocation and rebalances only if an asset class moves outside its allowed range. Small fluctuations are ignored because they do not meaningfully change the risk profile. This can make the process more selective than a fixed calendar schedule. Instead of trading because a date arrived, the investor trades because the portfolio truly moved far enough to justify it. In that sense, threshold rebalancing is designed to focus attention on meaningful drift. The trigger is built from 3 parts: a target weight, an upper limit, and a lower limit. Suppose stocks have a target weight of 60% and an acceptable band from 55 to 65%. If stocks are currently at 65%, they are still inside the range, so no action is required. If they move to 66%, they are outside the upper limit, and that breach triggers a rebalance. One simple way to measure the movement is drift, which is the actual weight minus the target weight. Threshold rebalancing turns that drift into a clear yes or no decision. Those bands can be set in more than one way. An absolute threshold uses fixed percentage points around the target, so a 60% target with plus or minus 5 points creates a range of 55 to 65%. A relative threshold uses a percentage of the target itself. For example, a 10% relative band around a 60% target equals 6 percentage points, producing a range of 54 to 66%. The difference may seem small in this example, but it becomes more important when target weights differ a lot across asset classes. Choosing between absolute and relative bands affects how sensitive the rebalancing rule will be. Relative bands can be especially helpful when some allocations are large and others are very small. A large target, such as 70%, may reasonably tolerate a wider movement in percentage points, while a small target, such as 5%, may need a much tighter point range to avoid becoming materially distorted. With a 10% relative band, the 70% allocation gets a plus or minus 7-point band, but the 5% allocation gets only a plus or minus 0.5-point band. That scaling effect can prevent small holdings from drifting too far before the rule responds. In other words, relative thresholds adjust the band to the size of the allocation. For diversified portfolios with uneven targets, that can create a more balanced system. Even though threshold rebalancing does not trade on every review date, it still requires regular monitoring. The investor first chooses target weights for each asset class, and then assigns either absolute or relative bands to each one. Holdings are checked periodically to see whether any weight has moved beyond its acceptable range. If a band is breached, the investor rebalances according to the pre-written rule. In some cases, they may bring the asset all the way back to target. In others, they may simply move it back inside the band. Cash flows can also be used first to reduce the amount of trading required. Investors use this approach because it can be more efficient than trading on a fixed schedule. It avoids transactions that happen only because a review date arrived, even when the portfolio is still close to target. That selectivity may reduce transaction costs and, in taxable accounts, may reduce unnecessary realized gains. It can also save time by limiting action to situations where drift is actually meaningful. The process still preserves discipline, but it tends to be less active than a strict calendar rule. For investors comfortable with monitoring, that efficiency can be appealing. The main trade-off is that threshold rebalancing reduces unnecessary trades, but it demands oversight. Someone still has to check the portfolio regularly enough to notice when a band has been crossed. Large market moves can push an allocation outside its range quickly, especially when bands are narrow. If reviews are missed, risk may drift farther than intended before action is taken. Bandwidth also changes the experience. Wider bands mean fewer trades but more tolerated drift, while narrower bands tighten control but increase trading frequency. So the method is efficient, but it is not passive in the sense of requiring no attention. Consider Maria's portfolio, which is worth $100,000 and targeted at 70% stocks and 30% bonds. She uses a relative threshold of 10% of each target. That means the stock band runs from 63 to 77%, while the bond band runs from 27 to 33%. Her actual allocation has moved to 78% stocks and 22% bonds. Stocks are above their upper band, and bonds are below their lower band. Because both positions are outside their allowed ranges, the portfolio clearly triggers a rebalance. Once the breach is identified, the trade calculation is simple. Maria currently holds $78,000 in stocks and $22,000 in bonds. Her target amounts are $70,000 in stocks and $30,000 in bonds. To restore the target allocation, she sells $8,000 of stocks and buys $8,000 of bonds. Notice the value of the threshold rule here. At 76% stocks, she would still be inside the allowed band and would not need to trade yet. The rule makes the decision objective rather than emotional. The exercise highlights several practical lessons. A rebalance is triggered only when the allocation moves beyond the band, not merely to the edge of it. That detail matters, because investors need rules that are precise enough to prevent second guessing. If bands are too tight, the portfolio may generate frequent low-value trades. If bands are too wide, risk can drift farther than the investor intended. Relative bands may be especially useful for smaller allocations where a fixed point threshold can be too loose. Good threshold rules strike a balance between control and practicality. Section 4. Tax considerations. Rebalancing may improve risk control, but in taxable accounts, the tax costs can materially affect what the investor keeps. Selling an appreciated asset often realizes a capital gain, and that gain may produce a tax bill. Two portfolios with similar pre-tax performance can end with different after-tax results simply because one generated more taxable sales along the way. That is why implementation matters so much in taxable investing. Tax-aware rebalancing does not ignore risk control, but it tries to achieve that control with as little tax friction as practical. The goal is not just to rebalance, but to rebalance intelligently. Account type is one of the first things to check before making a rebalance trade. In tax-advantaged accounts such as many 401ks and IRAs, trading usually does not create an immediate tax bill, so the main concerns are allocation and transaction efficiency. In a taxable brokerage account, the same sale may realize gains and reduce after-tax returns. That means every sale in a taxable account deserves an extra layer of review. An investor may prefer to rebalance first inside tax-advantaged accounts and be more selective in taxable ones. The portfolio level goal may be the same, but the path to get there can differ by account location. Holding period also matters because it changes how gains are typically taxed. Investments held for 1 year or less usually produce short-term capital gains, which are generally taxed at ordinary income rates. Holdings kept for more than 1 year usually qualify for long-term capital gains treatment, which is often more favorable. This means a taxable rebalance done too frequently may generate more costly short-term gains. In some cases, if a sale is close to the 1-year mark, waiting a little longer may reduce the tax impact without greatly changing the portfolio's risk. Tax-aware investors pay attention not just to what they sell, but also to when they sell it. One of the simplest tax-aware techniques is to use cash flows before selling appreciated positions. New contributions can be directed to the asset classes that are below target. Dividends and bond interest can also be reinvested in underweight assets instead of automatically going back into the same holdings. If the investor is withdrawing funds, those withdrawals can come first from overweight positions. When drift is modest, these cash flow adjustments may move the portfolio much closer to target without triggering any taxable sale at all. It is a practical way to reduce friction while still keeping the allocation under control. Tax loss harvesting can also support a rebalance when used carefully. If one holding has fallen below its cost basis, selling it realizes a capital loss. That loss can offset capital gains realized elsewhere in the rebalance, reducing the net taxable gain. If losses exceed gains, some tax systems allow a limited amount to offset ordinary income each year, with unused losses carried forward. This can make rebalancing more tax efficient, especially when gains and losses exist in different parts of the portfolio. Still, tax loss harvesting is a tax tool, not a reason to keep a weak investment strategy in place. A key caution is the wash sale rule. If an investor sells a security at a loss and then buys the same, or a substantially identical security within 30 days before or after the sale, the loss may be disallowed for current tax purposes. That means a tax loss harvest can fail if the replacement trade is handled carelessly. To preserve market exposure, investors often switch into a similar but not identical investment during that period. The idea is to keep the portfolio aligned while still respecting the tax rule. Ignoring wash sale rules can remove the very tax benefit the investor was trying to create. A practical tax-aware process starts with a sequence of simple checks. First, identify whether the rebalance will occur in a taxable or tax-advantaged account. Then review unrealized gains and losses, so you know which sales may be costly and which losses might be useful. Check holding periods before selling, especially if a gain is close to becoming long-term. Use contributions, dividends, and other cash flows first when possible, and if sales are still needed, see whether realized losses can offset gains. Finally, keep track of unused losses, because they may provide value in future tax years. Consider Chen, whose taxable portfolio has drifted from 60-40 to 68-32 after a stock rally. To rebalance, she needs to sell $8,000 of stock and move that money into bonds. The stock shares she plans to sell have a cost basis of $5,500, so the sale would create a long-term gain of $2,500. On its own, that gain would increase the tax cost of the rebalance, but Chen also owns a bond fund with an unrealized loss of $1,500. That creates an opportunity to lower the tax impact while still moving the portfolio back toward target. By pairing the stock gain with the bond fund loss, Chen improves the after-tax outcome. The stock sale creates a $2,500 gain, and the bond fund sale realizes a $1,500 loss. Netting the two leaves a taxable gain of only $1,000 instead of the full $2,500. She still reaches the target allocation, but with less tax friction. To avoid a wash sale issue, she replaces the sold bond fund with a similar, not substantially identical fund. This is a good example of tax-aware rebalancing. The asset mix is corrected, but the route is chosen carefully. Several common mistakes can undermine otherwise sensible rebalancing decisions. One is ignoring taxes entirely in a taxable account and focusing only on pre-tax allocation. Another is selling just before a gain becomes long-term, when waiting briefly could reduce the tax rate. Investors also need to be careful not to violate wash sale rules when harvesting losses. State taxes, year-end income effects, and other personal tax details can matter too, even if they are easy to overlook. And finally, many investors miss simple opportunities to use dividends, interest, or contributions instead of making extra taxable sales. Section 5. Rebalancing discipline. At this point, the technical side of rebalancing is fairly clear. What often matters more in real life is discipline. A good rule on paper does little if the investor abandons it the moment markets become exciting or frightening. Rebalancing can feel uncomfortable because it often asks you to sell assets that have been rising and buy assets that have disappointed. Headlines, recent returns, and strong emotions all push against that behavior. Discipline is what keeps the investor tied to the plan instead of to the mood of the market. Rebalancing asks the investor to do something very specific. Trim overweight winners, add to underweight laggards, and restore the portfolio to its intended mix. That may feel backward in the moment because recent winners often look attractive and recent losers often feel risky. But the purpose is not to reward what has already gone up. It is to control the portfolio's exposure. A target allocation expresses a chosen level of risk, and rebalancing preserves that choice. The discipline lies in remembering that the goal is risk control, not performance chasing. Discipline often breaks down through small exceptions rather than one dramatic decision. An investor may delay a rebalance hoping for one more favorable move, override the rule because of a news story, or trust a gut feeling instead of the preset trigger. Each exception feels temporary and reasonable when viewed alone. But over time, these small departures add up and leave the portfolio drifting farther from its intended design. The real danger is that written rules slowly get replaced by in-the-moment judgment. Once that happens, the process becomes harder to repeat consistently. A disciplined process usually has a few simple parts. First, set the rules in advance so the decision is largely made before emotions are involved. Second, use reminders, alerts, or scheduled reviews so triggers are less likely to be missed. Third, act reasonably quickly once the rule is triggered, rather than letting hesitation invite second guessing. Fourth, keep a simple log of what happened, including the date, the trigger, and the trades made. Finally, review the process each year to see whether it still fits the investor's goals, accounts, and practical constraints. Specific rules are powerful because they reduce room for interpretation. Writing down target allocations, exact review dates, threshold bands, and preferred action steps makes it harder to rationalize doing nothing later. For example, a rule might say to review every 6 months or rebalance if any asset class drifts more than 5 percentage points from target. It might also state that new contributions should be used first before any taxable sales are made. The more concrete the policy, the less it depends on mood, confidence, or market noise. Good discipline starts before the pressure arrives. Speed and accountability help protect that discipline once a trigger occurs. A recurring reminder or account alert reduces the chance that a required review gets overlooked. A defined execution window, such as within 2 or 3 business days, limits the temptation to wait for a better price. Keeping a small record of the date, trigger, trades, and any constraints also creates accountability. That record is useful later because it reveals whether the investor followed the process or kept making exceptions. In this way, discipline becomes something visible and reviewable, not just a good intention. A disciplined rebalancing process will not look best in every short period, and investors need to expect that. In a strong bull market, a portfolio that is allowed to drift toward the winning asset may outperform temporarily. A rebalanced portfolio may lag because it has been trimming the strongest performer. That does not mean the strategy failed. The success standard is not short-term appearance, but whether the portfolio stayed aligned with its intended risk and whether the investor followed the plan. Process quality matters more than whether discipline happened to look good last quarter. Maya provides a simple example of this mindset. Her portfolio begins at 60% stocks and 40% bonds, but after a rally it drifts to 68-32 in a $200,000 portfolio. That means she now holds $136,000 in stocks and $64,000 in bonds. To get back to target, she sells $16,000 of stocks and buys $16,000 of bonds. The important part is not that she predicted a downturn. It is that she followed her rule even while the winning asset still felt attractive. Abandoning a rebalancing plan often feels most tempting at exactly the wrong times. After a rally, stopping the process can leave the investor locked into a higher risk portfolio than intended. During a panic, stopping can turn fear into a permanent habit of avoiding needed adjustments. In both cases, the portfolio may remain off target for a long time, and the investor's true risk exposure drifts away from the original plan. Discipline does not prevent losses in bad markets, but it can keep those losses more consistent with the investor's chosen risk level. That is why the hardest moments are often the most important moments to stay systematic. The most common discipline mistakes all involve replacing rules with judgment calls made under stress. Investors wait for better prices, make only part of the needed adjustment, or use taxes as a blanket excuse to avoid any action at all. Some abandon the strategy after a short period of disappointing relative performance. Others ignore the plan entirely when markets become extreme, even though that is when discipline matters most. None of these behaviors are unusual, but each one weakens the reliability of the process. A strong plan anticipates these temptations and gives the investor fewer chances to improvise. A useful final step is to write a short rebalancing discipline contract. It can specify whether the approach is time-based, threshold-based, or hybrid. List the exact triggers and describe the action steps to follow when a trigger occurs. It can also state account location rules, such as rebalancing in tax-advantaged accounts first and using cash flows before selling in taxable accounts. Most importantly, it should include one simple sentence that reinforces the purpose of the plan, such as following it to control risk rather than predict returns. That written commitment turns a general intention into a repeatable habit. In the end, the best rebalancing strategy is the one the investor can apply consistently through both calm and stressful markets.